Unlock your potential with a comprehensive suite of investing tools and expert education with GammaEdge. Start your free 14-day trial today. So a little bit of history. There's a psychologist, Brent Steenbarger, I think is his name, who originally posted about the cumulative tick. I think it was as far back as 2008. I didn't pick up on it until somewhere in the 2013 area. And the way he had presented, you can search for his name and just type cumulative tick and you'll land on his blog spot, where he had really described some concepts around it. And the visuals that he had weren't all that great. But, you know, go ahead and start with that. Fast forward, and what I noticed was that when you start with just the white line, there are points where it turns. And I just serendipitously started creating moving averages that intersected at these lines. And I did that over the course of time. And what I ended up finding was that they repeated often. So from like 2015 or 2013 to 2015, I kind of honed it down, and you can see they're pretty much equidistant. Not exactly, and I'd be happy to provide the the intervals. It's all measured on a 1 bar or a 1 minute bar interval. The key takeaway to your question, how is it used to build the market model, was really by trial and error and just seeing where reversals occurred and starting to really develop it from there. So that was really from about 2015, to 2018, 2019, somewhere in that time zone. And then started really getting serious with it. And when we started GammaEdge, the founders of GammaEdge we met in another Discord. And I was presenting the market model in that Discord, and it caught, as it's caught a lot of your attention, caught a lot of attention there. And this was also the same time where we had started our discussions with a company called EdgeRater. And EdgeRater is a company that allows you to do all sorts of different types of back testing and Monte Carlo analysis, and do all sorts of different things with data. And I was able to work with the founder of that company to where we could export data from TradeStation and import it into EdgeRater, and then start doing things with that. And what we found was that it really confirmed what we had been talking about, but it put a definitive, this is how it works type of thing in terms of the performance, really solidified it. So for instance, let me call EdgeRater over here real quick. So for instance, we come up with these different test conditions, red greater than cyan, and, et cetera, and we can test for different conditions. Why that's important for this discussion is we're now able to look at probabilities, we're able to look at drawdowns, intratrade drawdowns, and we're able to assign different conditions of the market model when certain conditions are true. So you probably have seen the chart that describes, tag combo 20, for instance, or tag combo 8, which is a trigger day. And what all of this means for us is that we're able to look at a large number of trades over a long period of time. This is actually 10 plus years here. And we're able to ascertain in what's called a Monte Carlo. That's where you have a large sample and you pick a certain number of samples, calculate the statistics, put them back in the pot, do it all over again, and do that 1,000 times. And then you come up with what are called the left tail, which is the 5th percentile or 5th percentile, and then the 95th percentile. So for final equity, which is your profit, and then your maximum drawdown, this is your intra-trade. This is the heat that we take when we do these trades and apply them towards strategies. Again, 5%, 5th percentile, or the 95th percentile. MD50 and FE50, you've heard us talk about, those are averages. So the 50th percentile of anything is the average of that thing, right? And what is the average? It's the number of samples divided by one of observation. And it's comprised of three different things, which we've been putting in the status, market status channel a little more periodically here for you, so you get a chance to see it and disaggregate it, learn to teach your eye how to use this thing. So one of them is the CT, that is the instantaneous measurement or accumulation of tick. You guys are familiar with what we're putting here with the filtered cumulative tick, and then the one that resets every day. And then when we start looking at the kind of these signals in isolation, these represent different combinations of conditions where you're closing lower than the prior day, you're closing higher. We keep it simple. This is appropriate for the 0DTE. We call this this is the CT, or the instantaneous cumulative tick. We have something that we've called now called the railroad track for obvious reasons here, and it's just a series of very short-term moving averages, but they do indicate a very good turn. Sometimes they line up with the CT, sometimes they don't, but noting this is also very, very good. It's typically appropriate for 1 to 3 day trades. And then finally, we have the longer term ribbon. I just isolate what we call the cyan line and the red line. It's the longest term moving average and the shortest term. And the slope is what matters on these things, and the relative placement to each other. So when the fastest one is below the slowest one, it's inverted to the downside. You can see the slope is clearly pointing down. I put the CT on this graphic just to have a reference point. The idea behind this is that this is a history of where we've been, and eventually we flip. And knowing where we're going to flip, and knowing if sentiment has been down day over day, as we start coming up to it, the obvious question for everyone is, are we going to cut through this? Are we going to go to the north? And if we do go to the north, does it cause things to start to flip? Now, for the new folks who have been here, not been here very long, you've not seen the ribbon flip. Here it is flipping to the downside. It's a very clear, very distinctive pattern. This is back in August that we actually lost it, and you can see what happens when that occurs. The CT collapses, the railroad track collapses downward, and you get the collapse of the primary ribbon, and there should be no ambiguity, right? So this is telling you that on August 10th and August 11th of this year, lights out, and we have not recovered since then. We've tried. We've had a number of failed attempts, right? But we've not gotten out of this. And so when we all joke about prone to failure, now you see why, right? It gives us a very, very good indication. There's also periods where the market model trends up and we're riding above it, and we get some weakness, and then we continue up. Now, many of you have never seen this, but this happens, and you can tell by these are parallel, they're trending up, everybody's happy, singing Kumbaya. And again, that when that ribbon does invert for that direction, it's very distinctive, it's very clean, it's not a very good trading signal because it's already late, but it tells you it's a confirmational signal. And you can see what's happening here, right? In the day, we had some weakness, right? This would be a down day in an otherwise uptrend, confirmed uptrend, new uptrend, new uptrend, new uptrend, right? Continuing the pattern up. The railroad track pattern remains intact. Everything's going up. So the model itself, although it is not predictive, it has momentum because it reflects, we believe, it reflects sentiment and what the market is doing. So, kind of putting this in perspective, and by the way, it does whipsaw, right? You just saw whipsaw. I don't know if your eye caught it, but it does whipsaw from time to time. It gets very narrow as the market trades sideways. Nothing you can do about it. If the market's trading sideways, you should be getting smaller, and your time frame should be getting a lot shorter, because you're going to see this. You're going to go up a day. You're going to be kind of indeterminate. You're going to come down a day. You're going to go up a day. You're going to go down a day. And we're going to hear a lot of complaining about, that the market model's broke it. No, it's not broke at all. This is what the market is giving us. Trend followers, you're going up, you're going down, or you're going sideways, the way it works. So where are we now? I think the market model is clearly in a downtrend, but we're converging up into the ribbon, right? And so this composite view that you see here is those three that I was shown before, where we break them apart. This is the CT. It's the same one that's right here. It's just on a different scale. Nothing has changed with it. Railroad track pattern, it's the same one again. It's right here. Again on a different scale, and then finally the ribbon, as you can see. And so there's three different time frames that are provided here. I would urge everybody to learn how to, with your eye, to disaggregate this. Pick the time frame that you're most interested in, whether it be the 0 DTE intraday type of trades, which is the slope of the CT line, really tells you what you're looking for. Every trade begins with the 0 DTE and entry. If your trend that you're following continues, and often the 1 to 3 day railroad track will tell you that. You can hold that overnight, and if the trend continues, you'll get that continuation signal, and perhaps you can ride this thing for several days down or several days up, whatever the case may be. Now, last thought, we are in a downtrend, but we are now counter to it, and I think it's you can tell. I don't, for those who've been around for a while, this signal typically lasts about 4 days, 3 to 4 days, and then we get a pause, and either it'll continue doing what it was doing, going down more, or it'll start going up. In this particular case, we started going up. So the question is, after 3 to 4 days, do we start playing around in the ribbon, digesting the gains of the previous few days, or do we reject and go down? And your guess is as good as mine. Nobody knows that, but that's why we read the structure and try to figure out what we're doing. So, or the sum of the whatever parameter is divided by the number of samples. And so you're able to, kind of take a look and see what's the best case for drawdown, what's the worst case for drawdown, what's the best case for wins over a long period of time. Portfolio 837%. What's the worst case? 0.28. So you're underwater in those particular conditions, and you can see that the average returns and all this is all in here. So the question about how the CT was used to build the market model is really based upon